it's time to get technical, and so we've asked Nick Radge from the Chartist to show us something that might influence the way we invest. Nick, thanks for joining us.
Thanks, Peter.
Now, the beauty about talking to technical people is that we always start with a chart, but let's just say you've gone for the All Ords as the first one. What's the theme you want to talk about on that chart?
Well, the theme of the All Ords is we've just broken up to some new highs and we're just consolidating. We've been in a little bit of negativity, I guess, in the last couple of months, a little bit cautious. We've rejected these levels a number of times before. The US market's run very, very hard.
No rejection over there, mate.
And we've just been a little bit cautious, but we've got above that 5,100, 5,200 area. We're sitting there nicely now. If we can sit there for a little bit longer, I think we can run to 5,700.
Well, let's just have a look at your chart and just see if that sort of confirms your thinking. So here we go, waiting for the chart.
Yep, so we'll see what we'll see.
Yep.
Okay, so we've got a band of resistance there, if you like, not necessarily a straight line, but that sits between 5,100 and 5,200. You can see that we've bounced off that 3 times since late 2009, but just recently we've crept up and we're sitting on top of that. Now, if we can stay on top of that band, very, very positive, and I think we will then move up towards 5,700. Now, our view has been this has been a bear market bounce, not a new bull market.
Really?
That's our view. And that's been our view for a long time.
Okay, a bear market. So this would be, what, a cyclical bear market in a secular bear market?
In a secular bull market.
Yeah,
that's right. If we go all the way back to 1950, this is very similar to what we saw after the 87 stock market crash. We had a big shakeout, like you can see there on the left of the chart with the GFC. And then between, I think, about 1988 and 1992, we just sat sideways. People had had enough. They didn't want to invest in equities. Same thing kind of going on now. And we're sitting in a sideways band, and I think this will last for a little bit longer, and then we'll step up to the plate and move higher.
Now, when we move higher, are we still in a cyclical bull market in a secular bear market?
Yes.
Really? So you think this bear market is still going on?
Yes.
All right. And when do you think it? Well, it's a silly question. You don't know.
I don't know.
But okay.
I would like it to start tomorrow, believe me.
It puts you in a sense in a minority situation, doesn't it? Yeah.
Oh, look, bigger picture, I'm still very positive. And one has to assume, with very low interest rates, that we're going to start to see the growth come through to the economy. I know enough about fundamentals to do damage, so I don't want to go there. But common sense should prevail, and that's what we'll see.
Yeah, I was interviewing John Simon last week for a housing conference for Genworth, and he was saying that he was surprised that the low interest rates haven't brought the avalanche of people dying to get a home loan. He said they're coming in.
Yeah.
He says, I see this sort of grinding higher, but not like an avalanche that will create a housing bubble.
Yeah.
And it kind of confirms with what Tanya Brainwaite from Macquarie said. She thinks this cycle is a slow grind higher, which means that this kind of thing could go on for a while with an upward trend, but nothing too excessive.
That's right. And that might be a good thing.
Yeah, it might be.
And interestingly enough, when we get to the second chart, I think that's going to be confirmed in the price action of that second chart.
I think it's a sexier chart in terms of discussion. So let's go to that one.
Yep, sure.
And before we get to, okay, so you've got 2 colours there. One, the red one. What's the red one show?
The red one is the small ordinaries, and I've stripped dividends out. And the black one at the top there is the ASX 100. And again, I've stripped the dividends out of this.
Big versus small.
Big versus small. Now, if we think about the US market, every part of the market is making all-time highs.
Russell's even better than the
NASDAQ, I believe, last night made all-time highs. Is that right?
No, it made the best high since 2000.
2000, okay.
Remember, they got silly there.
Right.
For the dot-com bust. The 4,000 is a good level.
So what we've got is the Dow stocks, the S&P 500 stocks, the Russell 2000, the Wilshire 5000 across the board.
Yeah.
Now, if we just move away from all-time highs here in Australia, which we're a long way from, but look at the divergence between the big end of town and the small end of town.
And then what's really interesting, I'm sure my viewers at home are saying, in the past, they've kind of hung out together, the red and the green line. But there's been a split, and that split actually happened even before the GFC, didn't it?
No, the GFC is to the left, right in the very far. So the absolute lowest price there is 2009.
Oh, 2012, okay,
So what we've got in the last 24 months or 18 months is a significant divergence between the two. You can see sometimes we get little divergences, but this is significant. Now, I think there's 2 stories going on here. One, the dividend story, without a shadow of a doubt. We could probably strip just the the next 50 out of this and call it the bottom 50 and the next 250 and have the same picture, but I can't actually do that. So you've got the dividend yield play going on.
And can I just interrupt for a second? I know on this program I didn't want to tip stuff that would make my viewers hate me. So about 2012 I said, let's chase those dividends.
Sure.
They look so good. And then everyone was saying the same thing. And so logically, it's shot up.
That's right, and that's not going to finish anytime soon.
Right.
I mean, I'm not sure if that's your opinion, but with interest rates staying low and yields still around that 7-8%, how can it not stop? So I think that divergence is going to stay in place in the short term. But the interesting thing about that chart, going back to our earlier discussion, is effectively it's showing a no vote of confidence in the small ordinaries. Take the dividends out of it for the moment. I think you've got a very big no show of confidence, which is what John was talking about. And the analysts there from Macquarie Bank, same kind of thing.
Yeah. The $8 falling, could that help those small ordinaries?
I think it can't do any harm.
No.
Absolutely.
I think all those companies are very dollar sensitive.
Sure.
Yeah.
And I think we're going to go lower. Obviously, the jawboning coming out by the RBA now, they want it lower. And keeping interest rates down.
And you specialise in small stocks, so this is an area that you'd like to see kick up.
Our experience and our research clearly shows bigger growth in the small ordinaries part of the market. So that's where I personally participate. I don't go beyond the ASX 300, don't get me wrong. I don't go into the micro stuff. But that small ordinaries has double the growth over the very long term than what the top 100 does, ex-dividends. So I'm taking the view of the very, very longer term. So it's quite difficult to see this significant divergence. And the commentators to come on the TV and say the Australian market's at 5-year highs. Well, the top 20 are doing good. Everything else, not so good.
Nick, we're out of time. I'm really interested in I'll get you back to come on the program again. Thanks very much for that.
Thanks for having me, Peter.
All right, cheers, mate. That's Nick Radge from the Chartist.